welcome back to another episode of Spark Your Fire. I'm your host, David Shee, and with me today is John Comino, as always, my lovely co-host today, on a very different virtual background today, mate. Looking classy. What's going
That's
on?
right. Unrecognizable. I'm good, David. I appear to be in a skyscraper near the ocean, which
We're
seems
against
lovely.
skyscrapers ourselves,
Yeah,
aren't we, John? Why are you in
yeah, yeah.
there?
No, that's right. That's right. Puerto Rico, I think. No, I'm
Puerto
very
Rico.
well. I'm very well. How are you doing?
I'm great. I'm great. I'm great. For our listeners, look, we have changed our platform a little bit. So we're coming off Zoom and we're jumping onto Microsoft Teams. As such, I think the format, at least from the video side of things, could be slightly different than what we normally would be. But nevertheless, you'll still get the same great content as we always do. That's our promise, mate. So yeah, let's. I think it's been a while since we caught up, but I think I love these end of month episodes because I mean, we literally just got the inflation figures that just came out on Wednesday, so we're able to have a chat around that. So I think a bit of positive news so far. You got to look at. I mean, I'm a glass half full person. Let's put it that way. Um, so the July monthly CPI figure has actually dropped from 3.8 in June to 3.5%, which is actually good. It's encouraging because it's certainly trending down, but at the same time, it's not trending down as quickly as much as we liked it to. Look, the main categories that was contributing to that, pretty much housing, which is at 4%. Food and non-alcoholic beverages, 3.8%. Alcohol and tobacco, 7.2%. I know why people are just smoking a lot more. I think they're just drinking a lot more, potentially. And transport, 3.4%. Now, an important thing to note here, I think, John, is that the energy bill relief has now kicked in. So starting 1st of July. So this read of 3.5% in leading up to July 2024 is actually inclusive of the energy bill relief. So one of the reasons that the inflation has been consistently high was mainly housing, based on my memory. Housing was always high due to mainly the rent, the bills, the insurances, all that kind of stuff. So this one, technically speaking, is actually the first one that included the energy bill relief. So it's logical to say, yes, it's meant to come down. And I think that's broadly in line with the market expectations at the moment with that. So I guess the question is, are we going to see in the next few months whether it's going to be continuing to trend down even further and even faster like this? So I think that's going to be an important one there, John. Any thoughts? Anything you want to highlight on that figure, on that read?
Uh, well, I mean, as you say, sort of CPI is moving in the right direction. It
Mm,
was above expectations by 0.1%, but you're never going to get it exactly right. And as you say, the energy rebate, so like food and all these essential items were up, but housing was down because of this energy rebate. So,
yeah.
I mean, I actually think that inflation is going to continue to trend lower, or I shouldn't say inflation. I should say CPI will continue to trend lower, and I actually think that in a sense, because we know that the Fed is going to cut rates in September, I
Mm,
kind of feel like, broadly speaking, we're at the end of the high rate cycle. Chairman Powell, and I know this is the US, not Australia, but Chairman Powell said it's time for a change in policy, and this happened about a week ago. So
yeah.
where the Fed goes, the RBA follows. Even if our inflation isn't quite as tamed as the US inflation number, which it isn't, the stronger Australian dollar is going to put a lid on import prices. And I actually think that I still think that CPI is going to be moving lower in the next couple of months. Even if we're disappointed by the speed of that decline, I still think it's
Mm,
going to be moving in the right direction. And whether we like it or not, the FX market will probably force us to be cutting next year anyway, early
mm,
next year.
mm. So I guess, yeah, it's good that I suppose that's an indicator to say, look, there won't be any more rate rises. So
Yeah.
for the rate warriors, that's certainly good news. But at the same time, we're not too sure whether there is actually going to be any rate drops this year. I mean, I think CBA and Westpac are still saying that there could be one towards the end of the year. But
Yep.
reading what RBA's minutes has been saying for last month, basically the only thing that the board has been discussing was whether there was an up or an increase or a hold. So it's either an
Mm.
increase or hold. They certainly did not touch on a reduction at this point in time. So, I think I would tend to agree with you that it's more likely to be 2025 or at least next year before they would even consider on that option at this point, given that fact that like you said, 3.5% isn't really yet in the band. And this is with the energy relief bill as well. That's already in place. So, technically speaking, has it really moved much? I don't think so. Without the energy bill relief, I would say we're probably still sitting at around the 3.7, 3.8 today. So it's getting really, really sticky, which is what's concerning now, essentially. And who knows how much patience RBA board still has. They keep on saying they're getting impatient. They're getting impatient. They want this to be done and dusted within the band of 2025, right? So,
Mm.
but yeah, anyway, yeah. Look, I think it's an interesting one to see. Certainly, on the US counterpart, Fed is giving us positive news, so that's good. That's quite cheerful. But when would RBA be forced to actually pull that trigger? I guess, yeah, that's for
I've
anyone to
always said
tell.
February or March. I
Yeah.
think will be the first rate cut. Yeah, I think that. Look, I do think that the economic news will be deteriorating. So I think that if you had to be a betting man, you'd be saying whatever the consensus is, numbers will be worse, like employment and all those sorts of
Mm,
things.
mm,
And I really believe that. I think one of the things that's interesting is like, why is our unemployment number so low? And my view is that it's hidden in the NDIS figure. So all the people who might have claimed unemployment in the past are now being sort of shuffled into the NDIS system, and it's
mm.
hiding our unemployment numbers,
Oh, okay.
which is kind of a unverified hypothesis on my part. But I don't think the economy is doing well. But I think that we've got all these statistics that sort of hide how brutal things are at the moment. And I think we all feel it's tough out there, right? It is tough. Yeah.
It certainly is. So, I think, but it will be interesting to see, as you said, let's say hypothetically, in February or March next year, would RBA be forced to increase or sorry, to drop the rate even though inflation hasn't really hit that 2 to 3% band? What would happen then, John? Just, I mean, this is the hypothetical case, but let's say the inflation proves to be very, very sticky. It still
Mhm.
hovers around above the 3%. Unemployment rates kind of still relatively low with low fours, that kind of sitting around those low four figures. But with all the forexes and currencies and US
Yeah.
counterparts dropping their rates like fierce and ferocious, because that's going to impact our import and export big time, right? So, do you think RBA is going to be put into a position or into a corner where they kind of go, look, we haven't quite really hit the 2 to 3% inflation bracket that we really wanted to, but we will have to drop the rates no matter what?
I definitely think that that will eventually happen. So I think that there are two reasons why they would start to cut. One is that the Aussie dollar starts to get too strong, and I think they
Mm,
monitor that, even though they don't really talk about that too much. But I think that
mm,
if the Aussie dollar gets stronger than they're comfortable with, I think that that would be a reason to start cutting. Another reason is that even if inflation might be higher than they're comfortable with, unemployment starts to rise. Like they might have some
the
measure for
real
underlying
unemployment.
unemployment.
Mm,
So what they would then say in that instance is that even though inflation might not be perfectly within our target, or it's at the upper range of our target, we've done enough on inflation, and now we have a dual mandate, and we need to address the unemployment number.
mm.
So once they get it below 3%, which is probably fairly imminent, it's at 3.5% or so. Once they get to 2.9%, they'll probably say, look, there's momentum and it'll keep falling. We can start to cut. Um, I also think, I do think that we'll be in a recession by the next quarter if we're not in a recession already. So
A technical
um,
recession already at the moment,
technical
aren't we?
recession, yeah, these things are hard to read. They're also hard to figure. They're hard to, recessions are hard to measure in a timely fashion because you're looking for 2 quarters of negative GDP growth, which means you don't know you're in a recession until 6 months after you're in a recession. So,
That's right.
and sometimes you're out of the recession by the time they start to report it. So it's a very odd thing, but Yeah, I think there's going to be an easing bias. One thing to always bear in mind is the Federal Reserve in the US is the globe's central bank.
Yeah.
I mean, you could say the IMF is, but as long as the US dollar is the reserve currency, and the Fed is the globe's central bank to some degree. And if they're cutting all the satellite central banks, the Bank of Canada, the Bank of England, the Euro, the Australian RBA are going to have to cut as well.
Yeah.
And directionally, they will set the tone.
Yeah. Okay. No, good point. Look, yeah, certainly good to have your thoughts on that one, because that's something that's in the back of my mind, which I thought would be worth asking. So we'll
Yep.
see. I think yeah, RBA might be forced into that kind of position. But having said that, it is a narrow path that they've been walking at the moment, and so far, just based on numbers alone, it's not too bad. But
Yep.
it's only the everyday people in Australia that's really feeling the pinch right now, unfortunately.
That's right.
So yeah. All right. And okay, so that's I think that's a good summary in terms of the inflation figures and what we're expecting in terms of the cash rate movements moving forward. John, what's been happening around the property markets at the moment? I know you've had some exciting or interesting things to share.
Well, yeah, it's always exciting in the property market. So I bought a couple of properties in the last week, which is good. One was
For clients, not for
for
yourself.
clients. So both clients were owner occupiers, which maybe in itself interesting. But owner occupier clients, they
Mhm.
both bought apartments. One bought an apartment, a giant apartment in the St. George area. It was a 3-bedroom, 2-bathroom, 2 parking spot apartment with 160
Mm.
square meters on title. So one of those
Big, massive.
big balconies you can put a dining table on. Like it was a big apartment,
Yeah.
quiet street, close to the station. It was great. Like it's the sort of thing I would buy myself. Like I liked it a lot. And the other one was a penthouse in St. Ives in the Upper
Okay.
North Shore, other end of Sydney. Newer, um, beautiful skylights and all those sorts of things. It's a lovely apartment. And what I can tell you is that I mean, both were semi-competitive, but it wasn't a brutal bloodbath, and so
Mm.
it was reasonably competitive. There were other interested people. There were other offers that we had to contend with, but the kind of the feeding frenzy has come out of the market. So it wasn't. It was we were a couple of offers in, rather than this sort of ratcheting Dutch auction. It
Mm.
wasn't. It
Mm.
wasn't
Mm.
like that.
Mm.
The Broadly speaking, at the inspections, the St George area was busier, so there were people lining up out the front of the inspections, waiting for the agent to turn up. You didn't see that in the Upper North Shore. The Upper North Shore was definitely quieter, and
Affordability.
statistically, the North and the Upper North Shore are actually probably coming off a little bit.
Yeah. Yeah.
Um,
Yeah.
yeah,
I think that's to do with the affordability, isn't it?
yeah,
Definitely.
yeah. And for our listeners, the St George market, which is Cogra out to Hurstville,
Yeah.
even the beaches, Brighton, San Susie, it just dances to the beat of a different drum. So Sydney could be doing this, and the St George area is doing the exact opposite. So, and it's a strange old market, but Sydney is sort of softer. It's coming off in most parts, and the St George area is doing quite well. And I think it's because the St George area, and not to dwell on any one particular submarket within a submarket within a submarket, but it's because it's the spillover area for the children who grew up in the inner west and the children who grew up in the eastern suburbs, and they
Mm.
converge on the St George area because that's where they can afford now. So it's a very interesting market, which has a lot to offer. But so that was, but it's also got a very nice vintage of apartments. So you get those old walk-ups that are well made with no problems, and uh, they've got a lot of appeal. So
Yeah. Yeah.
that
Nice.
market's still busy.
Yeah. Okay.
Yeah,
Beautiful. Yeah. No, good
yeah,
to know, mate. Good to know. Owner occupiers as well, by the way.
yeah,
So
yep.
yeah.
And even but I must say, like a big peak. There's always a lot more uh, prospects at this time
Yes.
of year. So I probably sign up the most amount of my clients in October. It's because I think that people get to the end of the year and go, crap, we they look to better half and say we told ourselves we're going to buy a property this year and we've got 2 months to Christmas. So I always sign up a lot of people at this time of year. But even of the people I'm talking to, majority are owner occupiers.
Yeah, right.
Like by a mile, by a mile.
As in they want to upgrade or
They want to
first
stop
home.
renting. They want to stop renting, and that
Ah,
there are
okay.
older first home buyers in their 40s.
Older
Yeah,
first home buyers.
that sort
Interesting.
of thing. Mm, yeah,
Getting
I
sick
mean,
of all the rents that's been going up around Sydney, which I think is starting to soften a little bit as well at the moment, isn't it?
yeah. I, I'm hearing this. I mean, it's have with the rents, you kind of have to rely on what
What's actually being
the
rented
property
for.
managers tell you a little bit, but
Yeah.
I'm definitely hearing that as well. But as we said on, I think, a previous episode, whether you experience falling rents kind of depends on when the rent last went up, and that applies to landlords and tenants. So it's hard to know. I mean, I still think that rents are hovering at fairly high levels, but I don't really think, as a broadly speaking, they're going up. I think that, yeah, I'm not sure. It's hard to know because I mentioned a couple of moments ago that the people I'm seeing going into the market are owner occupiers, not
Yeah, that's
investors,
true.
or
Yeah.
that's where supply is coming from. But yes, I believe that rents are flattening out to coming down. Not sure why, but what are you seeing? What are you seeing in terms of the clients coming in to see
Oh,
you?
look, I think certainly there's the inquiry level from property investors is still strong in terms of my client side of things. So because I mean I'm buying them at the affordability type of purchase price. So,
Mhm.
around the 600K mark, that's still considered as relatively affordable. Certainly not looking at Sydney, that's for sure. Although, you know, it would be good to be able to get back into Sydney again. So we'll see. But yeah, there's still a lot of demand. People, especially people looking to, as you said, try to actually wrap up the year because they set themselves a goal to say, this year I want to get an investment property. If we're looking at end of August now, moving towards September, where am I? Okay, I've got almost pretty much a last quarter to try to get this ticked off. So um, and yeah, and look from a property side of things, there's still mostly still mostly buying around Perth at the moment, and prices still going up, like in the affordability ranges, because just there's so much demand for it. And
Yeah.
same with the Townsville market as well, very very competitive is what I'm hearing right now. A lot more people considering Melbourne now as well. Like they're starting to go a bit counter cyclical. Although having said that, cash flow is still the biggest issue right now for entering the Melbourne market,
Yeah.
which has always been the case. So, I think and probably not, it's that market is not going to move in the short period of time, at least not in the next 12 to potentially 24 months. There isn't really much incentives in those areas yet at the moment for that market to move. And land tax is still high. That's still one of the restrictions. So we'll see. But we will see. I have a feeling that soon Australia won't have any property that's kind of below the 500K mark or 550K mark, at least in the capital cities or the major regional
Yeah.
cities. There won't be anything that's below $600,000 just
Mm,
at this current pace. Yeah, and that's going to be the norm. Basically, the 600K might be moving more towards the 650, 700K becomes the affordability barrier. So anything above that, anything below that is just going to continue to disappear. So yeah, it's just interesting market, that's for sure. Lending wise, look, I think the lenders, the banks are certainly aware that the people need borrowing capacity, so they are scraping and they're trying to work out ways to be able to help people improve that borrowing capacity. So, I think just this week or the last couple of weeks, there's a few banks that's already owner occupier strata fees, which used to be counted as something in addition to the general living expenses, is now being factored in as part of the general living expenses now. So you know how expensive Sydney units and their strata are, right?
yeah.
Easily, or maybe $700 a month, or even looking at $1,500 to $2,000 a quarter. That could have a big impact in terms of the borrowing capacity. We're talking about potentially 50K of borrowing capacity changes just by including that owner occupier strata into part of the general living expenses. So, and I think more banks is going to follow on that soon as well. So, we'll see that's positive changes because that's going to allow people to push a little bit more for those owner occupiers who's living in units or looking to purchase units as well. So,
Right.
yeah.
Yeah.
Okay. So I think that might start pushing the unit prices up. As a matter of fact, fun fact, I think I skimmed through the CoreLogic report the other day. I think it's the first, probably won't be the first time, but in the recent months, the units has started to outpace the growth for houses. And
Right.
that's across a number of capital cities as
Mm.
well. So I think, this is going to start to accelerate in that because, like you said, affordability and having that extra bit of borrowing capacity allowed them to be able to purchase something slightly better from a unit perspective. So, and consequently keep driving up that. It's about time. I think it's about time that the units start to catch up and the houses will probably stay flat, given the fact that it has grown so much in the last, few years.
Yeah. I mean, if markets are like a weighing machine, as I think Warren Buffett said that, but he was quoting Benjamin Graham, I think. But markets are a weighing machine, and like the difference between houses and units are just out of whack. That said, there's more sort of when we talk about the shortage of properties in Australia, but in Sydney, and in my case, we're really talking about houses, and
Yes,
so. I agree that houses need to kind of reassert themselves. They're a bit undervalued. We talked about the replacement cost of a unit being like you basically buying these old apartments at cost, which is a
correct.
beautiful thing. But there's still no shortage of them. That's the difference. And I think if we look at the rentals are coming down more on the unit side, although I could be wrong on that. But yeah, I saw an interview with Damien Cooley and Mark Burris. So they're two people that are definitely worth listening to. They have their finger on the pulse. And Damien Cooley actually, as an auctioneer, probably one of Sydney's top auctioneers, Australia's top auctioneers, he has this data set which is quite unique, which is whether properties are selling above or below reserve.
Okay.
So the rest of us schmucks have to look at the clearance rates, but he has that this wonderful data. And he was saying that the things that are selling best at auction are houses. So it's I mean it's still I still think that it's a seller's market at the moment, and there's still reasonably good buying, even if it's flat to the end of the year.
Definitely. I
Yeah.
mean, if you can afford a house, that is. But looking at, in Sydney, how much like the average price, you can't even get a like a normal standalone house for at least 1.5 plus, right? Like even in a semi-decent type of suburb. So it's a big, it's a big commitment for people to have, and I think affordability is just the main thing. The other thing to worth considering is also, I think I haven't checked this, but pipelines of new constructions of units, which I think is actually at a record low at the moment as well. So in other words, it's going to be years with no supply on units as much. Yes, there has been a lot of supply in the past, but that's being eaten up at the moment. If there's no new supply coming in, then surely that's going to have to be a pressure force to keep pushing up on that side of things as well. So
absolutely, yeah. We're very aware of the impact that high interest rates have on the buyers.
Yeah.
So high interest rates kill buyers, but high interest rate kill off anything that requires leverage, which is in most cases sort of the construction of apartments. So high interest rates affect supply as well as demand. So
yeah.
yeah.
No, absolutely. Cool. All right. No, thanks for sharing that. Okay, well, let's move on to have a chat about this week's I guess the discussion topic that we want to jump in. So I think you've shared with me one of this Michael Yardney's article, I think, as a matter of fact. So and what it talks about is 4 in 5 people ended up selling in the first 5 years. So, most of the people actually fell in the game of real estate. So that was one of the key topics that we kind of want to explore. Now, to set the scene a little bit, just so with our listeners, so I'm just going to read our little blurb here. The problem is most people who get involved in property investment don't develop a financial freedom thereafter. Statistics show that 50% of new investors sell up in the first 5 years. So 50% of new investors sell up in the first 5 years. Most investors never get past the first or second property, and only around 21,000 Australians own 6 properties or more. I mean, this data could be slightly outdated, but I think it's still relevant as of today. In other words, less than 1% of property investors ever succeed in building a substantial property portfolio. Right, so that's one of the reasons that we want to use that as a bit of a discussion point to say, why is it so difficult? Why do people sell up so quickly? We all know fundamentally, concept wise, you need to hold the property long term in order to grow the wealth, in order to enjoy the compounding impact effect and all that stuff, right? In order to really create wealth in the long run. But having said that, when you actually do it, it's so tough. It's so difficult. Like, what are the main factors that's causing people to sell up in the first 5 years? John, I think you had a few good ideas there. So I'm gonna handball it back to you, and you can give our listeners a bit of thoughts on those.
Yeah, sure. So I've got 4 reasons. These are my reasons, but I probably kind of subconsciously adapted Michael Yardney's reasons. But
That's okay.
so add out and full credit because
Full
it's
credit.
something that he quite rightly talks about regularly. So my view on why most people, I think they said 1% of investors. It's not 1% of Australians. 1% of investors
1% of investors.
succeed in real estate, which is to say they buy multiple properties. The first reason, I've got 4. The first reason, we can go through them one by one, is expectations. I think people just get bored and fed up, and they lose their patience with what is essentially a game of patience. And their expectations going in is that, well, I've seen everyone else make a ton of money out of real estate. And if they don't make money in the first 3, 4, 5 years, they go, oh, sod it, and they decide that it's not for them. And I think that the expectations are the problem, because the people that these abstract people that they look at making all this money in real estate, they had to play the patience game. And the difference is that those people hung around in the property market, stuck it out, the good times, the bad times. And that's why it appears to them what was very much a marathon appears to the newcomer to be a sprint. And so my view is, firstly, misaligned expectations. Most of your capital growth is going to occur in bursts. It's going to occur in a short couple of years, but most of the time, real estate's going to be doing low single digit growth. This is the sort of big capitals on average. But I think that they want to be achieving stronger returns than that, because some internet guru said that it was possible. So patience and expectations. David, thoughts on that one?
Oh, look, I totally agree. I think it just comes down to, expectations is definitely the number one key criteria. And also, as you said, patience on seeing the growth. Because I mean, everyone, when you're purchasing and when you're purchasing an investment, and I think this is one of the downsides of how information transmits so quickly nowadays. Everyone just expects things to go very, very instantaneous, right?
Yeah.
Like a bit like shares, Bitcoins, people are just so used to volatility. They don't want a boring day, hey, let's check in to see what's going on. Oh, why is my property hasn't risen that much yet? They told me that, property is meant to go meant to double in every 7 or 10 years. And I have 7 or 10 years, I haven't seen anything or haven't seen much growth. That's the kind of expectations. And there's a lot of, there's obviously too much information on the internet, which could cause that expectation to be incorrectly aligned. And look, we have these conversations with our clients the whole time, right? To set that expectation. It's a long-term game. But like you said, it's it's that expectation that a lot of investors are expecting growth in a short period of time, and they want to see results. And if they do not see results, then it's a dud. No, I'm not holding on to it. I'm not holding on to it, right? So, and the other thing is also the type of I guess the other side is in relation to the expectation of how much effort you need to put into actively manage the property as well. So, that's one of the things that a lot of people thought, oh, it's a passive investment. So, once I buy the property, then rent comes in, mortgage goes out, That's
Yeah.
it. That's all I need to worry about. No, there's a lot of repairs, maintenances, there's tenant issues, etc., etc. There's always going to be things that's coming up which requires your attention. So property is not a passive asset. Property is a very, very active asset. You need to be involved in that. And most people, by the time they got to probably around the 4 to 5 years, they get really sick of it. Aircon's broken down again. You know, I need to replace that's a couple $1,000s. Roofing's having issue now. Oh, now do I need to actually get a quote for to repair a roof? What? So
Yeah.
all these
Yeah.
little things, keeps on, basically reset that original expectation that, hey, this is meant to be a easy way of building wealth, but it's actually not the way. So you're absolutely
Mm.
right, mate. Expectations, I think everyone in the long run certainly need to come in and expect that this is a difficult game to actually make money out of.
Yeah.
So,
Yes, I agree. I agree. It kind of takes me to point number two, because you mentioned that there's this expectation that it's passive, but it's actually active, and
yeah.
hot water systems are going to break down, air conditioners are going to break down. But actually, the thing that you're most actively managing month to month is the debt.
Mm.
It's I think Michael Yardney says game of finance, some bricks thrown in. I've always liked that one. So the other reason people fall out of the property game is they're not managing their finances. So they're not
Yeah.
managing the debt. We can debate whether you pay down the debt or you do interest only, but whatever the case may be, you've got to manage the debt, because I think, and I'm going to butcher the saying, but there's a saying about no one went bankrupt without debt. So the only reason you would run into distress is probably not the asset itself, although that could be a problem. It's
Mm.
probably going to be the debt levels against the asset.
Yeah.
So
Yep.
number two, manage your debt.
That's true. No, that's true. And it comes down, yeah, and it's to do a lot with how budgets, spending, and to a degree, interest rates as well. But I think a lot of times, you control what you can control. At the end of the day, and like from speaking from the personal experiences, when I was initially accumulating my portfolio, I've always added an extra buffer in terms of calculating, if I take on this much debt and if the interest rate's sitting at, let's say, 8% or 9%, am I still be able to hold on to it to a level? Because we all know when you buy a property, you'll essentially be able to buy the debt. If you can't buy the debt, then you don't have the property. So it
Yeah.
comes hand in hand. So, but what level of the debt should you be getting? That's something for you to consider and for you to be comfortable with. A lot of people just think, I'm just going to leverage and leverage and leverage and continue to leverage without deleveraging or without a plan to deleverage. That's obviously very, very dangerous.
Yeah.
Even though you and I have very different views in terms of whether it should be interest only versus P&R repayment. But like you said, ultimately, no one's going to go bankrupt without debt, essentially.
Yeah.
So, there has to be a way to consider this and be able to manage the level of debt. I mean, initially accumulation, yes, you're going to have to work with debt, and it's important to actually be comfortable working with debt as well. And I think that's another thing that a lot of the new property investors are probably not as comfortable with, because, there might be to do with the fact that their parents told them you should be just buying a home and then you just pay it down before you start looking at investing and that kind of stuff. So, your relationship with the debt to a degree, has a very big influence in terms of how much, whether you are able to succeed in property investment. Because if you look at it as a foe, or if you look at it as a friend, it's a very different view of it, right? And
Yeah.
yeah, so it's a double-edged sword. Basically, debt can
Yeah.
help you propel to the next level, but at the same time, if you don't manage it well, it can also ruin you. So something to keep in
Yeah.
mind.
I like the way you put that. Your relationship to the debt. It's so true. How much you've got, how what your interest rates are, all that stuff. I think that's such a massive component. So manage your finances. Have a good broker like yourself,
Mm, mm.
because whether you succeed in real estate is going to come down to finance, mortgages, debt,
That's right.
repayments.
That's right.
Number three, I had cash flow. Not managing your cash flow, which is really the other side of the coin of how to manage your debt and finance. But I guess it has another level, which is also, so in addition to all the things we said a few moments ago about managing debt and managing finance, and
Yeah.
getting the right finance solution for you, it's also how you manage your rents. So it's the cash flow coming in as well. And it can also include things like depreciation and so on. But so look after your tenants, but also I think you should be as aggressive as you can be with your with your rents, but you should keep good tenants and not have high vacancy rates. So all that sort of stuff. And it comes back to your initial point where property is an active asset. So you have to juggle this, and it is like running a business. You've got to be savvy. You've got stakeholders at the bank. You've got stakeholders as the tenant. So you have to manage all of that. You've got to coordinate all of that to cash flow this asset.
Yeah.
To cash flow.
No, absolutely, mate. Look, cash flow is definitely one of the most important aspects in terms of managing and be able to hold on to a property portfolio as well. And when I think a lot of times when we talk about cash flow, it's the first thing that comes into my mind is a lot of people think that they want to be able to purchase a property that's positively cash flow from day one, which is very, very different because, I can tell you a lot of times those property companies who want to sell you properties will give you a really lovely spreadsheet that has everything broken down to detail. And they might be putting in a loan amount that's 80%. They might be putting in a very low interest rate just to fudge around the numbers a little bit so it looks feasible. Plus, adding a bit of depreciation, especially for brand new properties. And you go, here's a positively geared property that you can just take it home for as much as X amount of dollars. But essentially, once you bought into it, then there's a different reality because depending on the type of repayment that you're going, depending on the type of bank, the interest rate that you're going to be heading into, it's very, very different. So don't get. I think one of the things that my client comes to me a lot of times, David, I want to buy my first property, my first investment property. I want it to be positively geared. I said, mate, to be honest, in today's environment, not possible. Like residential properties are not meant to be cash flow positive on average. Like, if you're comparing it to like a 2%, 3% interest rate back in COVID days, yes, you can get those positive cash flow ones. But on an average interest rate between 5 to 7% today, no, you're not going to get something out of that. So you need to reset that expectation that, hey, these properties are meant to feed me money from day one rather than me feeding it money. I mean, the analogy that I usually use is like, it's like a child, right? Like you kind of had to feed the child. You had to contribute the child up until the time where he's a teenager, be able to work and be able to earn his own income to be able to get to that level. Property is no different. It's like a child, right? You need to constantly feed into it, nurture it, look after it, and then ultimately it's going to give you that return. I'm not sure about the kids, but anyway, but that's a side story. They may not necessarily do that. But I think that's one of the very important things about managing cash flow. The other one is about income. So your PAYG self-employed stuff. So managing cash flow also means that you should be very, very careful and mindful about your job because that's most of the time, that's the only source of income in a household. And if you lose your job, do you have enough buffer to be able to hold on to these properties? Especially, I think this is a very relevant conversation today when we're heading into a bit of economic uncertainty moving forward, with a lot of people getting made redundant moving forward. So this is definitely a pre-planning or fore-planning that anyone who's looking to build a property portfolio should be looking into, because managing cash flow sometimes does mean if you lose your job and if you don't have enough cash buffer, mate, you're going to have to sell. That's the bottom resort, but some people may have to, in unfortunate circumstances, right? And don't forget, property is not a liquid asset. It takes time to sell as well. You may not necessarily be able to find a good buyer. You may not be able to settle within 6 weeks. There's a lot of ins and outs. So, from the time you decide to sell until the time you get sold and you get your money in the bank account, it will take time as well. So, look after your job, make sure that you've got plenty of buffer that you keep in your bank account. How much? I guess it's subjective, to be honest. Personally, I kind of like to have at least 6 months of repayments in my bank account at least, but that's just me being conservative. I try to have more if I can. Certainly in the offset account, you can never go wrong. Yeah, always have a backup plan in terms of managing your cash flow and sit on a healthy cash flow. I think that's 101 for anyone who's wanting to be able to build a property portfolio, really.
Yeah, I like I like that a lot. I like that a lot.
Rabble
Yeah,
on
no,
too much. John doesn't know where to start.
very good. I had one thing to pick up on, and I've lost it. But no, spot on. And so the last thing I had was buying the wrong property.
Mm,
So
mm.
the last thing for why only sort of 1% of property investors make it in real estate is buying the wrong property. So buying the wrong property can mean a lot of things. It almost ties into expectations a little bit, like the property doesn't kind of deliver what its purpose was. You might have bought a property that was supposed to be income oriented, or you might have decided to buy a property that's a growth property, like a big block of R4 land with a tiny house on it. That would be a growth oriented property.
Yeah.
But buying the property that doesn't match your goals or your expectations is the issue there. I suppose that the two examples that that people most give about buying the wrong properties, which is unfair, but let's go there. The first type of property that people talk about is like mining towns.
Mm-hmm.
Now, you can make a lot of money out of mining towns, but they're not great buy and hold investments over a long period of time, because they're going to eventually sort of go through a mega boom and then correct. Because there are so few economic drivers, they've got generally the mine, the mineral. So mining towns are potentially sort of error number one, or buying something that's too niche like that. And the other example, and I hate to bring it up because a lot of listeners would be expecting this, but would be like new or off the plan. And it's not that they're bad investments, but they're probably not going to grow. So you probably will get a decent cash flow, but without the growth, you're kind of missing out on a lot of the reason why people buy properties. So buying the wrong property is the other reason why people throw their toys out of the pram and decide this is not for me. And I can understand if you buy an off the plan property and 10 years later, it hasn't grown, you've been left behind, right? Thoughts, David? The wrong property type.
I'm on the pointy end on the wrong property, right? So I do have my my Granville off the plan property, which is my first property. So I'm absolutely putting my hands and feet up in terms of agreeing with you on that one. Seeing it has no growth after 10 plus years, and it still costs me a lot of money at the moment to actually get things fixed, is certainly not a great feeling. But yeah, look, I think, and this one is again tied to, like you said, expectations. What do you want this property to do? I mean, I don't think there's a thing as per se wrong property. At the end of the day, it's a dwelling. Like fundamentally, you got to think back. It's a dwelling. It's for people to live in. But your expectation on that property determines whether it's the rightful purpose or not. Like you said, if you purchase a house on a R4 big land block, you expect it to grow. Yes, it would. I mean, in the long run, given the location, given proximity, given rezoning, yes, it probably would have that capital growth perspective. If you're buying it off the plan, and if you want the same type of potential growth or the capital growth, no, it probably won't happen. But you may get better cash flow from that off the plan property. Who knows? I'm just saying subjective, right? Like, so your expectation of the property that you bought is going to make a big key differences in terms of whether you are wanting to hold on to this property in the long run or not. Yeah, look, having a portfolio of all the off plans is probably not something that I personally would want. I would certainly want to have capital growth properties, basically pigeon paired with cash flow type of properties, so it becomes a bit of a balance moving forward. Yeah, luckily, I think properties are very forgiving assets. So in the long run, generally speaking, you wouldn't go too bad. But having said that, I'm still on a pointy end. I'm still being very solid about my off the plan property at the moment. So don't get me started on that, John. I think that's for another episode.
No, I agree. And I didn't want to pick at a scab there, David. I
No, that's okay. No, I'm just
talk
kidding.
about that property
kidding.
from time to time. But I think you need. I mean, I think it's also important to have the battle scars, and I've got them as well. Like there are properties that I've bought that it's just wrong. They haven't performed, and I'm all the wiser for having done it, and I can bring that value to clients. So it's okay. It's all right. So they're the four I had. I'm sure there are others, but I actually think they all come under those categories as to
You're
why,
right,
and Australians have a love affair with real estate. I mean, if you've ever been to a barbecue, which is all of us, or a family gathering, that's what people want to talk about. And yet, despite that, so few are actually successful in real estate, even despite this obsession that we as a culture and we as a country have. So what are we doing wrong? And I think they're the four things. And just to recap, I think it's the wrong expectations and not having enough patience. 2 is not managing your debt and your finance. Number 3 is not managing your cash flow. and number 4 I had was buying the wrong property.
Yeah. Yeah. No, great summary, John. I think that sums it up pretty much pretty well. Yeah, most of those yeah, certainly can be categorized under those 4 broad categories that I can think of as well. So yeah, I don't think there's any more things that we can add at this point. So
Awesome.
beautiful. All right. Well, thanks, John. Thanks for another great episode. Look, I think that's it for wrap for us today. Listeners, hope you guys all like it. And I'm certainly feeling that the spring is in the air now. So keep an eye out. I don't know whether it's going to be a strong spring market or not, but I'm sure, in a fortnight, John will be able to give us further updates on that as well for the Sydney markets. Until then, have a good week, and we'll chat to you guys soon. John and David.
Right.